It's safe to say you and I grew up on different music.
I love these options. They make us money. Everybody get your roll on. What? Hey, everybody. I'm JC Parets, founder of AllStarCharts.com, and I am joined by my esteemed colleague, Mr. Sean McLaughlin. What's up, Shawnee?
What is happening, JC?
We're getting a roll on. Just like the big timers would have wanted.
Is that an antiperspirant? What is that?
Everybody get your roll on. What? Right? I have that song stuck in my head all day. Shout out big timers.
We've been talking about $100 rolls around here, so JC's got rolls on his mind.
When we put on some of these trades, it reminds me of songs. You know what I mean? So here we are with the $200 roll, and I'm like, the big timers would appreciate this one. And so we were just listening to some jams. Sean's like, you grew up listening to way different music than I did.
Very, very true.
Oh, okay. So let's explain. So we put on earlier this year what is arguably the best trade we put on all year. Correct me if I'm wrong. Maybe has the potential to be the best trade we've ever put on at All Star Options. Right? Do I have that right?
It has the potential. Yes, it's not quite there yet, but certainly it's our best trade of the year so far. It's still open. But yeah, back on February 2nd, we did a live stream just like this, JC, where we talked about how we wanted to buy leaps, 2 years to expiration leaps. So
not like us at all.
Yeah, not unlike us at all, or not like us at all. January 2024, we bought options that expired. So basically 2 years from when we put this trade on February 2nd, we bought the 150 strike calls. As you could see, our timing was pretty good. I mean, it went sideways on us for, a couple of weeks, no big deal. But then in March, it really started taking off. You could see there. And according to our plan, as we always do with long calls, we sold half of our position at a double of what we paid for it. And since then, we've been holding half a position with no risk, JC, which is a very nice position to be in, especially when we have another 18 months to ride this thing. This thing could go to the moon, baby.
And listen, we're not always buying leaps 2 years out. In fact, we are never doing that. We've never done that. We haven't done it since. So, I talk a lot about sort of strategy drifting and sort of getting away from, you always need to be careful with that. When you see your hedge fund manager strategy drifting, like there's a problem. This was not that. This was the fact that volatility was very low, right? The initial entry volatility was very low. It just gave us a long time to go out. So it was one of those situations where we asked ourselves, hey, listen, this was as we were breaking out here. It's like, do we want more energy exposure over the next 2 years or do we not? To me, it was that simple. Do you want energy exposure for the next 2 years or do you not want more energy exposure for the next 2 years? To me, it was that binary. For me and the rest of the crew, we were all like 100% yes. We all agreed. We all want more energy exposure for the next 2 years. This was a cheap way to do that, and it turned out great. Now, just because that trade is working out so well doesn't mean that there are not other opportunities in Chevron. In fact, there are, but this is a different situation, right? We want to talk about it?
Right. So, in our analyst meeting this morning, we were kicking around ideas of what we like, and we just can't stop coming back to the energy sector, the energies and oils and exploration. These stocks are the stocks that are holding up like champs in this market. And we were saying, look at charts like Chevron. They're just, not only are they, near highs, but they're coiling is the phrase that Straza used. These things are coiling and they just look like they want to spring higher.
I'm so proud of you, Sean. Look at you with your technical analysis. Are we reaching the apex? Is that what's happening?
Ooh, I'll leave that to the experts. I'll leave that. Yeah. But we were looking at the Chevron in particular and yeah, we already are positioned here. And as a general practice, and Straz and I talked about this in a live stream yesterday, as a general practice, I don't like to add another layer into a trade I'm already in. For me, it's a psychological thing, but I kind of like to let trades stand on their own and do their thing. But this setup here, if I had no position in Chevron right now, And I saw what Chevron was doing today. This chart doesn't even reflect today, JC. We've broken above that higher level there.
New all-time highs, Johnny, baby. New all-time highs. Not
That's right.
Downtrend.
And if I was not previously positioned in this stock, I'd be like, we got to get long here. This is a great setup. It's almost, I mean, I hate to use the phrase textbook, but it feels like a textbook setup. We want to get long.
Volatility is more elevated, though, than last time.
Volatility is more elevated. So we said, all right, well, if we were to get into a trade here, how would we play it? We wouldn't buy calls like we did last time. I mean, we could, and potentially we can make money trading calls, but the odds make it, the implied volatility makes it a little harder for us to realize a gain doing it that way. So we said, hey, look, this stock is coming up just below 180 right now. The $200 level is just lurking above there, acting like a magnet, like these big round numbers often do. There's a good chance that if this thing breaks out, which it's doing right now, 200 we can get there quickly. I mean, I'm not saying it's going to happen next week, but it could happen. But once we get to 200, that might be a logical area for this stock to pause for a little bit. So we said, hey, let's put on a spread. We'll sell the 200 strike calls. There's great premium there. It's more of a tactical trade. We're still keeping that long leap trade on that has until January 24. These are two separate independent trades. But we like our opportunity here for kind of hit and go kind of thing, right? Like we just want to play for the $200 roll and move on.
Listen, at the end of the day, we probably could have maybe done something like this in Exxon, maybe through an ETF. So it really is more of a coincidence than anything else, just the way the numbers line up. So just to be clear, what we're doing is we're buying a CVX Chevron October 180-200 bull call spread for approximately 6.5. That means we're long the 180 calls and short an equal amount of the 200 calls. And that's going to give us a net debit. That's the most that we can lose. So if we do get that $200 roll and Chevron gets its roll on, if you will, that should be no problem to hit our target, which we want to close for twice the amount, correct?
Yeah, I've got a resting order to sell this spread for a profit at $13.25. That would represent capturing half of the maximum potential profit we could earn in this trade. So we paid $6.50 for it, right? The most the spread could be worth, if both options expire in the money, would be $20, because that's the difference between the strikes. You got the 200 strike on the upside, the 180 call strike a little bit lower. That's $20 difference, right? So that most that spread could be worth is $20. If we paid $6.50 for it, then the most we stand to gain is $3.50, as you can see in that chart. So basically all I did here, it's just simple math. I divided $13.50 in half, which is $6.75, added it to my cost, which was $6.50, and the total is $13.25. So that's the price we're trying to exit this spread out, which if we get that, that represents a doubling of our invested capital. Excellent. And it represents capturing 50% of the maximum gain without having to hold this spread all the way out to October. I have no plans on holding the spread all the way to October, JC, if I can help it. If we hit our profit target next week, great. I'm out and on to the next thing.
Now let's go. I want to go over a couple of things. First of all, the most we can lose in a worst case scenario, the world ends tomorrow. You can't lose more than what you put into it, which I like, right? You're kind of like a limited partner in a hedge fund. You can't lose more than what you put in there. So I like that. But there are still ways to mitigate risk even further, right? You want to walk through that?
Absolutely. So if the breakout that we're looking for does not materialize, or if it fakes out, because actually the breakout is happening right now, but if it reverses on us and fakes us out, I'm going to be keeping an eye on the 155 level. If you want to bring up that chart there, which kind of corresponds, right around where that last green arrow is pointed. That's 155 right there. If we close below that level, that's my signal that, hey, we're wrong here. We're either early or wrong. Either way, I don't like it and I want out, and we will look to close the spread at that point. Who knows what we'll get for the spread at that point? It kind of depends on how soon that happens, right? I've talked about this in the past. When I put a spread on and I'm wrong, the sooner I'm wrong, the better, because in that case, the loss is usually pretty small. Now, if we held this position and it kind of went sideways for the next 4 months and it finally broke below 155 in late September, at that point, our spread will probably be close to worthless, but the chances of that are pretty slim. This thing's either going to work, JC, or it's not. And we're going to find out pretty quickly, I
Well,
think.
not to get all macro on you. I know you like to, fall asleep when we start talking about credit spreads and the other kinds of credit spreads, right? In the bond market, and we start talking to global macro. I think even you, Sean, even you can say, wow, look at this move in Chevron, look at this move in energy, look at this move in oil, despite the rising dollar, right? Even Sean gets a little macro sometimes, right?
Sometimes if I woke up on the right side of the bed.
So what happens if the dollar falls apart here? How do you think? I mean, if commodities did so well, energy did so well, despite a stronger dollar, if you start getting that weaker dollar, what does that mean for energy? So what I want to show is this is a monster base going back a decade, right? Huge base. We got the breakout, right? That's when we put on the trade in February. And then we consolidated. And you can't really tell because this is a monthly chart, but this is what that consolidation looks on a daily basis, as we just saw, obviously, right? So this is what that looks like. So here's a zoomed in version to what's going on here. But let's, whenever in doubt, zoom out, right? Let's talk about what's going on. So we are increasing the probabilities of success simply because of the type of strategy that we put on. It's a higher probability of success versus just going out and buying calls, especially with volatility at a much higher level than where it was when we put on the long calls in February, right? And then you have the increased probabilities of success because you have the underlying trend that you're back, right? So you're sort of like compounding probabilities, is how I want to look at it. And you know what? If this doesn't work and the trade works against us, let's just say, I'll put it on another 100 times, right? This is the types of trade that we want to put on, is how we look at it, because we're talking about the $200 roll, right? What? Everybody get your roll on? What? Right?
Brandon, cut his mic quick.
Tell the kids what the $100 roll is, and therefore what the kids don't know. Tell the kids.
All right. So for those of you who are wondering, what the hell are we talking about? The $100 roll is a phenomenon that is frequently observed in the stock market, that when a stock is making all-time highs, let's say it gets above 90, and that's an all-time high, there's something magical, I put that in quotes, about the 100 level. It's just one of those levels that acts as a magnet. Traders love big, round, whole numbers. And we've seen it time and time again that when a stock breaks 90 for the first time, it so frequently will not only get to 100, but will quickly exceed 100, even kind of overthrowing it a little bit before coming back. It happens time and time again. And then we see that process repeat itself at 200, at 300, at 500, all the big round numbers. It happens far more frequently to be a coincidence. We've seen it so many times.
And then whenever you're playing that $100 roll, give a shout out to the big timers. What? Everybody get your roll on. All right. So we are buying a Chevron October 180-200 bull call spread for approximately 6.5. That means we're long the 180 calls and short an equal amount of the 200 calls. This is in October for a net debit. I like it, Shawnee, baby. I like it a lot. And Chevron has treated us so nicely. Oh, this stock is near and dear to my heart, which is probably a bad thing. You can't, the fact that I love Chevron so much, I got to check myself, I think.
Well, hey, do your part. We got a long weekend coming up, Memorial Day weekend. Fill up that gas tank. Go for a long drive. Think about your stock position.
Yeah, I'm going to the beach. Can't wait. All right, guys.
There you go.
Adios.
Take care, everybody.